inflation has jumped up faster and more persistently than had been widely expected. Until the middle of last year, 2021, the forecast that was made by most central banks, Bank of England, European Central Bank, and the Fed, was that inflation might rise only temporarily to somewhere about 3, 3.5, maybe a little bit more, and would then, by the late autumn, start subsiding rapidly. Instead, inflation has risen considerably more, is now running at about 7% in the US and slightly over 5% in both the US and the UK. And what is more, it's showing no signs of subsiding. Indeed, with the increase in energy prices that you all know about, the increase in gas prices, electricity prices, petrol prices, and so on, the expectation is that inflation will rise over 7% in the UK and maybe a little bit more in Europe, and may flatline in the United States. In other words, considerably more. And how fast and when it may decline, nobody really knows at all. Now, the immediate pressure in the UK is not only that energy prices are going to rise really very sharply, but you've got an increase in the national insurance contributions. So if nothing was done, and wages and earnings remained unchanged, people's living standards would decline with really a sharp jump, one of the sharpest jumps ever, over this spring, April, May. Now, we could get rid of some of that problem if we wanted to by having major public sector subsidies so that your energy, your gas bills don't go up, improve payments for the very poorest, and so on. And some of that does need to be done, particularly to relieve the positions of the poorest. Nevertheless, if subsidies are going to be handed out very widely to the population in general, and remember we all use energy and gas and petrol and so on, then the effect on the public purse would actually be very large indeed. And this is at a time when the fiscal position is historically pretty weak. In fact, it's historically weaker than it has ever been in peacetime. It is certainly true that in the UK, wartime, not only World Wars I and II, but the Napoleonic War, drove the public sector debt up a great deal higher than it is now. But wars are temporary, and after a war gets over, the norm in the past has been that we get back to a more prudent fiscal position with balanced budgets and even at times surpluses, and that combined with some inflation has always brought the post-war surge in debt down to more normal levels. I'll show you a picture about that very shortly. Moreover, rising nominal interest rates and indeed inflation itself are going to make the fiscal position quite a lot worse because the debt is so high that when interest rates rise and you have to pay higher on inflation-protected debts that has been issued, the amount that has to be paid out in debt service rises pretty sharply. Now, none of us has really noted the massive increase in public sector debt that has occurred in virtually every advanced economy. And the reason why none of us has noted that has been because the rise in public sector debt has been offset virtually one for one by a reduction in interest rates. So the debt servicing costs, which really are what matter, have not risen at all. And in most countries have been slightly, but they're very slightly declining. That is about to turn around with a vengeance. And I'll show you some figures about that. And at the same time, the experience of very low interest rates, historically low, have made it easy, relatively inexpensive in terms of debt servicing, for people to go into debt in order to invest in various things and to buy houses and so on. And with the very low interest rates, negative when you take account of the increase in inflation, real interest rates at the moment are running at levels of about -5%. In other words, virtually zero nominal interest rates and inflation at -5%. But that is a level of negative real interest rates that, again, with a few exceptions, has never ever been seen in normal Western economies. Now let me show you a little bit of a few pictures and a few data. First of all, I'm going to show you the picture here of the public sector debt ratio, the ratio relative to GDP of the United States. Why have I done it for the US rather than the UK? I've done it for the US because the Congressional Budget Office, that's the group who does the forecasts, have done a post-COVID forecast. This is the forecast that they provided last June of the likely development under present policies. Given existing tax rates, given existing development of the working age population, their likely productivity, and the increase in output and taxation that will arise, that will occur. On the far side, the left view, you will see that at the moment in the United States, the debt ratio is just about as high as it was at the end of World War II. The UK is still a lot lower than it was at the end of World War II, but note that in the US, as in the UK, the debt ratios declined pretty sharply after World War II under the influence of a more restrictive, if you like, and less expansionary fiscal policy, and indeed some inflation. What's more, and this is one thing that I want to emphasize, this is not due just to COVID. COVID is a small bump in what is a very strongly upward rising trend. Now, why have we got a very strongly upward rising trend? Basically, the reason is demography. The reason is that there's been a lot, life expectancy has grown really quite dramatically, and we all live a lot longer. The gap between the age at which you get a pension and the age that you die has been increasing consistently for decades. On average now, if you retire at 65, you can expect slightly more if you're a woman, slightly less if you're a man, something like about 20 years of staying in retirement. Back when Bismarck first developed pensions, the pension age and life expectancy were the same, equal. So your expectation of life in retirement was very short. Meanwhile, the birth rate, where we had a baby boom in the decades immediately after World War II, that tailed off for a number of reasons related to contraception, improved women's education. People were able to make a choice about the number they wanted to grow in their family, and for having a birth rate where the number of children per women in the years where there was a much higher birth rate was in the 4 to 5 per women range. It is now in most Western economies well under the sustainable rate, which is 2.1 children per woman. It is now actually in the COVID years it has fallen to the lowest virtually ever rates. And that is not just the UK, it is not just Protestant countries, the birth rate in Catholic countries. It is particularly marked in China with the one-child policy, and in many of the countries now the birth rate has actually fallen below 1.5 per woman. If you wait long enough, and at your age you will actually see a development where the population of most of the countries of the world is actually going down. There's one exception to that, which is Africa, where the birth rates are still very high, and the share of the world population that will be represented by Africa is growing dramatically. The population of Nigeria within 20 years will be greater than the population of either Europe or of the United States. And policies with respect to Africa are going to be absolutely crucial over coming years. Now, given the fact that there is an upwards projection, the first thing is, why is there such upwards projection in the public sector deficit? And the main answer is that we, the old, and at 85 I'm certainly one of them, we're very expensive. We're not expensive because we eat more, or we buy more clothes, or we go for more holidays, where we do a bit in retirement. Basically, the reason we're expensive is not that we just get old, It is that we become incapacitated and unable to look after ourselves, and we need care and we need medicines. And that care and those medicines are very expensive. And the diseases that incapacitate the old, like me, dementia, Parkinson's, to name but two, are areas where modern medicine has made no forward strides. Modern medicine has done wonderful things for heart disease and cancer. On dementia, and I believe in Parkinson's, so far it has done virtually nothing. And the share of us old who become incapacitated and need this additional care and medicines, Medicare and Medicaid, grows exponentially with age. At my age, almost 50% of the population need additional care. I may look fit enough, and I am, but my wife has severe dementia and can't really cope with life at all. I could only come here because we have 24/7 care. My brother died of Alzheimer's not so long ago. By the time you are old, and there will be many of you who are old, the proportion of the population suffering from these incapacitating diseases, if medicine doesn't come through, and we can't base policy on hope, will be very large. So, the old involve a massive increase in the amount of expenditure needed, and the number of you, the forthcoming working age population, relative to the old is going to be diminishing, because the growth of the working age population is going down. Whereas, I think it was 15 years ago, there were probably something like about 7 of working age population between 20 and 65 per old person. It's going down dramatically. It is now somewhere around 3 or 4, and you, the working age population, are the people who do all the production. And so we're having to shift more of what the workers produce to the old, who are not producing anything, in order to look after them, provide them with care, and provide them with medicine. And that means that on existing present policies as they stand, with present pensions, present health care, no success in dealing with dementia, declining growth of the working age population, etc. Under present policies, the fiscal deficits, even when COVID is just a blip in the rear mirror, is going to go up and up and up. Now, does that mean, to paraphrase Dad's army, that we're all doomed? And the answer, of course, is no. It is always possible to change policies, and if we're going to stop the fiscal deficit simply going up and up and up, we would actually have to cut back some benefits, or we're going to have to raise taxes. Raising taxes is horribly politically unpopular, and because taxes are distortionary, they act to reduce effort, they act to reduce investment, which reduces growth further, and cutting benefits, if you like, the relative share going to the old, medical support and so on for the old, that too is politically unpopular. And what's more, the old vote much more than the young vote, so it's unlikely to occur. And again, the question, is austerity necessary? No, it's never necessary, because you can always put off the need to change policies, raise taxes and lower benefits to some future year, some future group. And that's obviously what politicians want to do. So what happens if we just keep putting it off, and the fiscal deficits and the debt ratio rise and rise and rise? Ultimately, it can't go on. Ultimately, what happens is you don't cut benefits effectively or raise taxation. What happens is that the debt ratio rises so high that people get scared that the state is not in a position to repay. Don't believe it never happens, it does. It very nearly happened in Greece with the crises in 2012-13, with Italy, think Argentina. It has happened in the past, it can happen again. Then you may say, well, surely the state can never go bankrupt, because it could always print money to pay off the interest payments. But if you print masses and masses of money, what you get then is you get masses and masses of inflation. So you inflate it. And again, don't think that that doesn't happen. It does. Now, it's not only the state, the public sector, that has got into such a massive amount of debt, it's also the private sector. And again, don't think that this is just the UK. What I'm talking about is not UK specific. This is the Western world as you have it, and indeed much of the rest of the world. Look at what has been happening to the debt ratios of the non-financial corporates over the last 15 years or so. In fact, the UK comes out of this relatively well. We have got a relatively lower. I think we're the only one on this diagram, this chart, where the debt ratio is actually lower than it was in 2007. That was partly because we had a rather worse time in the great financial crisis, and we've somewhat learned our lesson. Look in particular at what's happening to the debt ratio in emerging economies: China, South Korea, Hong Kong, Chile, Brazil, Turkey. Debt ratios have gone up and up because the monetary policy has been so expansionary, interest rates have been so low. What's going to happen now that inflation is resurging, is pushing ahead? Well, what central banks do is they raise interest rates to try and reduce inflation. If you raise interest rates, this debt becomes much more difficult to manage to pay back. If you can't pay back your debt, you go bankrupt. And so the danger here is that when the US starts raising interest rates... Oh, sorry. Where's the question? You pay for it. But when the US starts raising interest rates, particularly the emerging economies are going to be in a much worse position. And spare a thought for the emerging economies. Life is going to be pretty hard for us all, but it's going to be even worse for the emerging economies, much of whose debt is denominated in US dollars because it's easiest to borrow internationally in US dollars. And what happens when that occurs is that as the US interest rates start going up, as the Fed is effectively going to start in March, capital flows out of emerging economies into the United States. Their exchange rate weakens, and they find themselves in a much worse position. And the emerging economies have much less fiscal space and monetary space to restore the position than the advanced economies, including the UK. Now, another feature of the very easy monetary policies, the massive expansionary monetary policies we've had over recent decades, have been that asset prices have gone up dramatically. If interest rates are very low, then it is easier to take out a mortgage because the debt servicing costs are so low. If interest rates go down, bond prices go up. If interest rates go down, then the price of equities goes up because the price of equities depends on discounting what you expect to get in future dividends and so on over time. That's a picture of average house prices in the UK, and as you can see, they went down with a bit of a bang after the great financial crisis in 2008-9, and have been going up dramatically. Again, this is not just a UK story, it's a world story. In fact, the rise in prices in the UK has been rather less than most of these other economies: Germany, Canada, Australia, the US, and China. And here we've got asset prices, again, US equity prices. And these housing prices, land prices, equity prices, bond prices, were, because interest rates have been so low and monetary policy has been so expansionary, have reached sort of dramatically high levels on any historic basis that you like to name. And that means that as interest rates go up, as they are going to, the asset prices will go down. They might go down with quite a pump. Bitcoin has already halved. Don't think that that's the end of the story. It's not. We're just at the beginning of the story about raising nominal interest rates because the inflation is going to be worse and longer than we feared. So what may happen? If the fiscal floodgates open to try and deal with some of these problems, particularly the loss of earning power as inflation rises and you get the national insurance tax, then inflationary pressures are enormous. Otherwise, the increase in inflation and higher taxes of themselves lower living standards. Now, one of the features of the recovery from the crisis and the change in demography has been that the labour markets have become very tight. Vacancies are rising very sharply, unemployment has been going down. There are now in most of our countries more vacancies than unemployed. In other words, every unemployed person, there is at least one open job that they could go into. What is more, when there was working at home through COVID, and the fact that asset prices went up so much, and there was quite a lot of it, therefore, if you like, a woke around, a large number of people getting towards their retirement age decided that why the hell should I go on working, the horrible commute to work, my nasty supervisor at work and all the rest of it, and so they decided to jack it in. There has been a somewhat unexpected surge in retirements, the great retirement surge. The participation rates of the number, particularly of elderly, who are still below the pension age, but who've decided to jack it in and work no longer, has meant that the working age population has gone down with a bit of a bump. Now, given tight labour markets, and they are very tight, vacancy signs everywhere, people desperate to get workers in to be able to produce and provide the services that they've offered. Given that the labour market is very tight, the workers are not about to suffer a decline in their living standards from the higher inflation and the higher taxes. They're not just about to suffer them quietly. A normal person, if they can get more wages and find their position, their living standards under threat, will ask their boss for more money. And when labour standards are tight and people quit jobs to get to better jobs, the bosses are going to pay. What is more, given what we've been through, do you really expect the government to tell the nurses in the National Health Service that they've got to take a cut in their real living standards? Do you expect public sector wages for teachers and other people doing these kind of jobs to go down? It's inevitable, pretty much, that there's going to be really quite a sharp rise in earnings and wages. But that adds to the costs of employers. Employers are taking costs from higher transport costs. They face the higher energy costs as much as you do, and commodity prices are going up more generally. Add in the increases in wages and earnings as people want to protect their living standards, and what you get is what is known as a wage price spiral. And when you get a wage price spiral, nobody comes out of it. Wages chase up after prices, and prices chase up after wages, and it can just go on indefinitely. That, of course, is why the Governor of the Bank of England, rather, I don't know quite what the proper adverb is, I think it was 2 days ago or yesterday, said that workers should actually try and moderate their wage demands. And he was knocked down, he was cut down by the Prime Minister, who said, actually, I want to see high wages. And of course the Prime Minister wants to see high wages, but don't believe that that's going to be offset by productivity. High wages effectively mean high inflation. So, what are we going to have? What's going to happen? Well, what's the options for the Bank of England? It's responsible for price stability, got an inflation target. But given labour shortages interacting with real incomes, the increase in real wages is actually almost inevitable. Now, under these circumstances, if you do too little in raising interest rates, then the inflation dynamic, the wage price spiral, becomes built into the system. And the wage price spiral is already beginning to circle. It's underway in America and the UK already. It's not yet underway in Europe, in the continent. Wage demands, earnings are growing by less. The shortage of labour on the continent is somewhat less than the shortages in the UK and the US. And the expansionary effects of fiscal and monetary policies on the continent have been less than in the UK and in the US. Now, if you do too little, you get a wage price spiral and inflation, and it gets worse. Do too much. Remember how indebted we all are, how indebted corporates are, the amount of indebtedness that ordinary people have taken on for their mortgages and you could get a financial collapse and a recession. And if we got a recession, it would just make things worse, because tax revenues would go down, and unemployment expenditure and so on would go up, and the fiscal position would get even worse, and that in the longer run would make things really pretty bad. So we're faced with a very nasty position, where on the one hand a little bit too little, and we get endemic inflation, on the other hand a little bit too much, and we have a recession. Is there a happy mean between these two? In some senses, I would go a little bit towards not overdoing the interest rate increases. Don't do too much, don't do it too fast, although we're a long, long way away from equilibrium. A long way away from equilibrium. And interest rates have got to go up fairly steadily, fairly far. The question is not doing it so much, so soon, that you actually prevent a recession. It ain't going to be easy. And how will the politicians react as the interest rates go up and they find that the public sector position worsens because of the need to pay out much more in the way of interest payments on the very large debt that we now face? Now, how did we get into this mess? And it is a mess. I think it was partly due to mistaken analysis. Quite a long time ago, we worried about trying to work out the way the central bank should run the system in terms of the rate of growth of the money supply. And there was a relationship between monetary growth and nominal incomes. The demand for money was thought to be quite stable. Put in other words, the velocity of money was thought to be quite stable. In practice, the relationship between money supply and nominal incomes became too unstable to rely on, and now central banks hardly talk about monetary aggregates at all. Then what we turned to as economists was the Phillips Curve relationship. I don't know how many of you have already learned about the Phillips Curve relationship, named after Bill Phillips, New Zealand economist who went to the London School of Economics. And he studied the relationship between inflation and unemployment over the years 1985, I think it was, up to about 1958 or something, excluding the war years. And he plotted out where when unemployment was low, lower than 3%, inflation tended to rise. When unemployment was higher, because the bargaining power of labour was low relative to the bargaining power of employment. If there were many people seeking a job and there weren't many job openings, wages would remain low, and that would mean that prices could be low too. And when unemployment got very high, the demand was low and there was a lot of recession, and demand for goods and services was falling off quite sharply, prices too would be cut. And that was the Phillips Curve relationship, was the way most central banks sort of tried to look at our economy until probably about 10 to 15 years ago. What happened then was that the Phillips Curve disappeared, or rather it flattened out. The blue dots are the Phillips Curve relationship between unemployment and wages growth between 71 and 92. You can see it's upward sloping, and in fact, if you take one of the top ones, there's a bit of a sort of curvilinear relationship. But that curvilinear relationship at the upward slope just disappeared at the end of the 90s and the beginning of the 2000s. And for many years, until very, very recently, the situation appeared to be that it didn't actually matter how low you drove unemployment, how tight the labour market was, because inflation remained very, very low. And that was the norm. People began to believe that inflation would remain low more or less forever, and that you could drive sort of the pressure of demand up, and you could have a high employment economy, particularly in order to give employment to the less privileged in our societies without much risk or without danger. What we got was what you might describe as the well-anchored expectations theory of inflation. Now, it starts from the position that changing wages and prices is costly, and it is. If you try and raise prices, you have to change all your price tags, you have to change all your advertising, you have to worry about what will happen. If negotiations between employers and employees is always a bit fraught. Right? Going to your boss and saying, boss, I want a raise, is always a bit difficult, even embarrassing slightly. It's hard on both of you. Negotiations between groups, between trade unions and employers is time-consuming, it's difficult, it's fraught. So you don't just change your wages and prices because of what is happening at this very moment. What you do is you change your prices and wages depending on what you expect to happen over the time period during which your wage or price contract remains constant. And remember that most trade unions arrange a contract whereby a wage is sort of relatively fixed for 1 year, 2 years, or so on. Now, the success of hitting the inflation target, and it was a success, inflation was kept pretty damn near to the target of 2%, and for most people that was more or less equivalent to being fairly flat. From the sort of early 1990s onwards, gave central banks credibility. And so there was a general belief that if the central bank guaranteed price-wage stability, that no one would want to raise their prices and wages now because they were frightened about generalized inflation in future. So if they weren't frightened about inflation in future, they wouldn't raise their wages and prices now. So there'd be no generalized inflation if only we could keep inflation expectations well anchored. It was almost a sort of bootstrap theory of inflation, whereby you keep inflation low by people thinking that inflation will remain low. And if the central bank has credibility, they will believe that inflation will remain low. So it sort of all depends on sort of belief and credibility. Now, the expectations are important. Long-term interest rates, for example, are a function of expectations of future short-term interest rates, because you can always arbitrage between a series of buying short rates or buying a long rate and holding with it. Expectations are important for wage price spiral dynamics, but it was, I think, a matter of total hubris to believe that expectations are all that matters. And a lot of central banks got into the trap of believing that expectations are all that matters, given the possibility of demand and supply shocks. And we have had some dramatic both supply and demand shocks, particularly supply shocks recently. And also I think it is hubristic to think for the central banks to believe that credibility is sufficient to control expectations if and when such shocks occur. Now, why did inflation even undershoot targets for 2010-2019? And part of the history of this is that despite credibility and strong expansionary measures, negative interest rates, quantitative easing, inflation came in a bit below target. And there are two sets of theories. One is the theory that is most, I suppose, publicly being supported by Larry Summers, an eminent economist, ex-Secretary of the Treasury under Obama, was that there's a secular stagnation because the tendency for people to save has been, and he argues, will continue, greater than the tendency for people to want to invest. But I don't think there's any real rationale why that is true. Now, in the book that Manon Pradhan and I wrote, called the Great Demographic Reversal, we argue that the main reasons have been demography and globalization. In particular, the single most important macroeconomic world feature of the last 3 or 4 decades has been the rise of China, the economic rise of China. Now, the economic rise of China has had a dramatic effect on the world. It's had a very deflationary effect, disinflationary effect on the Western world for 3 reasons. First, employers shifted offshored their production to China, where wages were much, much lower, so goods prices went steadily downwards. Second, it gave every employer in the country who was in a position, potentially, to shift production out of their own country to cheaper countries such as China and Eastern Europe, a stick to beat their workers with. They could say, and they could say with credibility, if you don't abate your wage demands, we are going to move our factory to Wuhan or Shanghai or Budapest or wherever. That threat of offshoring was effective. Third, it transferred employment from manufacturing to services. Manufacturing, where people work in masses together in a factory, are easily unionized. Hospitality sectors where a few people work together in a pub or a hospitality outlet are not well unionized. It is much harder to threaten to strike in the service sector than it is in the manufacturing sector. So labour bargaining power went way, way down. If you had nothing to offer but your labour, in the Western economies like the United States, you did lousily over the last 30 years. Your real wages never increased. If you had access to capital and could benefit from shifting production to low-wage economies, you had a wonderful time. Been the best 3 decades for capital the world has virtually ever seen. And not only was it globalization, but it was the demography. The very high birth rate after World War II, followed by a sharp decline in the birth rate, led to a massive rate increase in the working age population, including, as I said, in China. The left-hand side of the graph shows those the working age population in China and Eastern Europe, both of which joined the world's trading arrangements in the 1990s. The blue shows the working age population in the standard Western world, Europe, North America, Australasia, and so on. You can see that with China being the most populous country in the world, the very fact that China and Eastern Europe joined the working age, joined the world trading system, more than doubled the available workforce for anyone who could move their production from one place to another. And you can see how much the working age population increased. The right-hand side chart shows it on an annual basis. Note in particular on the right-hand side, China, which is in the light blue, how it went shooting up until about 2010 and is now actually negative. The Chinese working age population is declining. The Chinese are frightened about demography. The great cry in China about China is it going to get old before it gets rich? Well, it's got fairly rich. And that actually leads me on to the questions about equality and inequality. Most people think that the world has become much more unequal in recent decades. That's not actually true. The reason is that the inequality between countries has now dramatically declined. In as recently as 2000, the ratio of wages of the ordinary Chinese worker to the ordinary American worker was something like 35 to 1. It's now down in 2018, it'll be a lot lower now. It's now 5 to 1. It's a change of a factor of 5. A factor of 7. In 20 years, a factor of 7. And that's been due to a massive increase in Chinese wages, real wages, and a stagnation and decline in American real wages. Much the same has been happening in Europe, only much less so, with real wages in the East increasing relative to real wages in the West. The demographic issues, fall in the birth rate occurred before life expectancy rose. So fall in the dependency ratio of those who don't work and can't work because they're too young or in school and university, and those who are too old and retired. Much more than that, with the decline in the birth rate, women have been moving from home to workplace. And that means that with the working age population being half women and half men, of course, when I was, this is the dependency ratio, you can see how the decline in the number of young between 1970 and 2010, and how this is now ending. That's because the fall in the birth rate had already occurred 20 years ago. So it's only going to decline, birth rate is decline very little. Whereas the increase in the number of the retirees, was quite small until about 2010. It's now going to absolutely gallop ahead. As I said, the ratio of workers to old is worsening quite dramatically. Now, this shows the relationship between women in jobs and men in jobs as compared with those without. And you can see that when I was young, most women, particularly married women, did not join the workforce. That was the age when most people didn't have refrigerators. You had to go out shopping every day. And that was a day when they all had more children, so they were looking after children. Now, it's all changed. Look, for example, about the age at which a woman has their first child, on average. Back in the 40s and the 50s, it was actually below 20. Hard to believe it. Now it's over 30. So that the ordinary young woman will go into the labour force for at least about 10 or 12 years before they start thinking about having a family. And that means that people will have families for much longer. How that will affect our behaviour and the economies is really yet to be thought about. But that demographic dividend, when the working age population shot up relative to the number of young and old, is now over. It changed about 2008. Working age population is now going down. It's gone down with a bit more of a bang in COVID. It's going down in Germany. It's going down in China. It's going down in Korea very sharply. It would go down. It would go down fairly quickly in both US and UK if it was not for immigration. The only thing that is keeping the working age population up in our countries is immigration. And of course, immigration may come under increasing social and political controls. As a result, with the labour market tightening for demographic reasons and also for globalization, globalization is in reverse. The struggle, if you like, between China and the United States, combined with a rise in wages and purchasing power in China, means that China is the idea that China is going to be the workshop of the world and provide cheap goods for everybody, that is going to change and no longer be the case. The disinflation from China is ending, and it may go in the other direction. Because they haven't appreciated that supply side changes are bringing about a massive and rapid change in the relative bargaining power and position of labour, they didn't see it coming. When inflation surged to 40-year high levels, the labour market's tight, and unemployment falling really quite fast, less so in the European Union, and policy is still largely expansionary. It's going to change, and it's going to change quite rapidly. But the margin of spare between too much and causing a recession, which would make everything worse, and allowing inflation to get really endemic in our system, is really very, very slight. Whether the central banks can work their way through that without running into one or other problems is very, very difficult to see. Now, let me end on this note. What does it mean for you? Okay? Some things are good. When you have finished your education, whether it's university or just school or whatever, you will be facing a very tight market, which will be very keen to get your work. And as you are relatively high-level educational standards, you'll get pretty good pay. You will get a good job very easily. Unless, of course, central banks overdo it and force us into a recession. And they could, and they might. And don't believe it's impossible, it's not. Let me tell you what the bad thing is going to be. You are going to face much higher taxes throughout your working life than most of the rest of us did. Maybe, let me give you the other thing that you'll have to face. The idea that you're going to retire, any of you, whether you're a man or a woman, at age 65 is for the birds. The retirement age by the time you get to retire is going to be 70, and you could be higher. The average working age in Korea and Japan, where these demographic factors are already working rather faster than here, is now over 70. I know I'm an anomaly, still doing a bit of work at 85, but there are going to have to be a hell of a lot more anomalies like me around, because the shift in the age balance is such, we simply cannot go on affording allowing people to stop working at 65. It's going to be a very, very different world as we age than we now have. And most of society including, I fear, central bank economists, have not really appreciated what the longer term effect of demography on our world is going to be. It's going to be a pretty difficult few years. And it's going to be, in some ways, probably, a more difficult life for you than it was for me, in that I lived through a very nice and easy time. Mervyn King expressed the decades from 1990 to about 2007 as the nice years, non-inflationary, continuous expansion. The nice years have come to an end. How we will get through the nasty years is going to be your job, not mine.
Thank you very much, Charles. We have perhaps time for one or two questions, if anybody has any questions.
I was wondering, what was the reason behind the Phillips Curve flattening?
Very good question. The answer that the central banks gave is that they had credibility and everyone had come to believe that inflation would never come back, and therefore you could run the economy at a much higher pressure of level of demand than we had previously. And not only could run it, you should run it. Take, for example, the Fed, which is trying to, which until very recently has argued that you should try and reduce unemployment dramatically because that would improve the conditions of the black and Hispanic segments of their population. The answer that my colleague Manuel Tyler and I give in our book is rather different. The answer that we give is that over these years, for the factors that I've explained, the role of China, the weakening of the bargaining power of labour, hardly anyone ever talks about trade unions now. And when I was young, Harold Wilson used to ask the trade unions to take their tanks off his front lawn because they were so massively powerful. The bargaining power of labour has cracked, it is diminished. And this occurred fairly slowly over time. And as the bargaining power of labour declined, so the ability to run the economy at a higher level of demand increased. The greater the bargaining power of labour, the more they are in a position at any level of unemployment to ask for higher wages. The higher the level of unemployment has to be if you want to keep price stability. So you can take your choice. You can either believe it was central bank credibility, or you can believe that it was the weakening bargaining power of labour. Those are the two explanations I know of. In economics, you'll find that there are always about 3 or 4 explanations for every fact that you want to discuss. And you have to choose which explanation you think is most appropriate.
Thank you. Was there another question?
You talked about how the demographic factors are going to lead to the end of the good times. But you talked about how these demographic factors are going to lead to a lot of economic problems for our generation. What about what will be the long-term impact of scarce resources and the economic problem on that? Do you think that would worsen our situation?
The security is a political issue, which I really can't. I'd like actually just to take the opportunity again to go back to the point I made about Africa, if I may. The area where the demography is still, in a sense, favourable is Africa, because there's a very large growth of the working age population. The issue really is, can Africa supplant China as a way of offsetting the worsening demography in most of the rest of the world? And there are 2 ways that it could happen. The first way would be by massive migration of Africans from Africa to the rest of the world. I think, whatever one may think about it, I think it's politically sort of impossible. Most countries, for one reason or another, tend to be upset by immigration by people who are not exactly like them. The Japanese, for example, more or less refuse to allow anybody who's non-Japanese to come into their country. And I think the idea that you could have large-scale migration from Nigeria and Ghana, for example, to, say, Europe, is just not politically and socially possible. The alternative is to transfer a large amount of production capacity to Africa. And I think a great deal of it will occur. But the great question then in Africa is, can there be sufficient infrastructure, sufficient government capacity, and sufficient education of the workforce to allow that to happen? And the answer to that is, it's possible. I'd like to see it happen. It's a question about whether it will happen.
Okay, one final question.
Do you believe with the rapid rise in inflation, like for example with the Phillips Curve, for example with the Phillips Curve, that of course current economic models you taught to us or detect us will become obsolete?
They change. Models change according to what occurs. One of the features that you will find in almost all the models that you will get taught at university is that they focus almost entirely on demand management and demand shocks. I think the effect of COVID and again the effect of demography is going to be that the models that will be used will have to incorporate much more attention to what is happening on the demand side. Another feature of most of macroeconomic analysis is that it is done entirely on the basis of a single country at a time. That's almost inevitable because if you're in the Treasury or the Bank of England, you're interested in what's going to happen in the UK. But nevertheless, if you're going to do economics properly, in an open economy world, you've got to look at what is happening to developments in the world more largely. The UK is a relatively small economy. One of the problems with macroeconomics is that macroeconomics is now largely done in the US, and most of the American macroeconomists take very little notice of what's happening outside the United States.
Okay, we'll finish there, and I thank Charles very much for his event.